Good afternoon, everybody. This is James with 77 Financial Group. You're listening to 15 Minutes of Finance, where in the next 15 minutes, I bet I can get you excited about investing. Let's do it. All right. Happy Friday, everybody. We have a beautiful, beautiful day to be invested in the stock market. Can't wait to cover it with you. Guys, last week I talked for 40 minutes. The week before, I talked for 40 minutes. Not going to do that today. Okay, I am keeping this to 15 minutes or less on my mama. And my mom listens to this, so I better do it. Shout out to my mom. Love her to death. Hey, before I jump into the news, which is good, we love to talk about good news, I got a segment for you guys, okay? It's something special we're doing in May, and it's just for the podcast listeners. So take a quick listen to this. This doesn't count towards the 15 minutes, and then I'll get right into the news, and we'll talk about all the good stuff. All right, I'll see you guys soon. Hey guys, James here. We are doing something very special for the month of May. It's our first time doing it, and it's free, okay? Free. Let me reiterate it again. Free. Financial plans. Boring, stupid, doesn't sound fun. I don't like the term. Doesn't make a lot of sense, okay? Very expensive. People charge between $5,000 and $10,000 to have a snapshot of where they're at. It's not worth it, okay? And those are scams. We are offering financial plans, how to grow your wealth. Okay, if you have a 401k, you don't really know what you're in, or you kind of know, but you're not sure how expensive it is, or is it costing you money that you could keep in returns, that's what this is for, okay? We're going to help you with your 401k allocation, your IRA allocation. I get a little bit of extra money. What should I do with it? How do I invest this? I'm 30 and I want $1 million by the time I'm 50. I'm 35. I've got a wife, a kid, and I don't really know what to do to secure the situation with the funds. Okay, that is what we're here to help you with. This is what we're doing for the month of May. Free financial plans. Even though I hate that word so much, we are going to help you build wealth, and we will tell you exactly what we would do if we were you. Okay, I have opened up the schedule for the whole month of May. Now, obviously, we have walk-ins and people calling us to set up meetings, but I have opened up the Calendly for people to segment up time. Almost every day has a window of opportunity for just the podcast listeners. That's you. We are willing to provide you a second opinion, and you by no means have any obligation to work with us. We are just happy to help provide the advice, and maybe after you're doing well, you'll decide, hey, this podcast is worth sharing with someone. So that's all we're doing right now. It's nothing, no money, okay? It's completely free, and we're just trying to help you out. So if that's something you're interested in, please check out the Calendly. And by no means you're obligated to work with us, but if you want to, you're able to as well. All right, guys, let's get back to what you came here for, the good stuff. I'll talk to you guys later. Okay, guys, I'm back. Hopefully you didn't suffer too much from that. I'll be honest with you. It was difficult to do because I hate ads, and I don't know how else to tell you guys that we're doing something really cool for free. So hopefully that wasn't too miserable and you got some value out of it. Okay, let's read the news here. U.S. stocks jumped on Friday with the S&P 500 notching its longest winning streak since November 2004 as a solid jobs report and possible thawing in U.S.-China trade tensions boosted spirits on Wall Street. The S&P 500 added nearly 1.5% to climb above its closing level on April 2nd when President Trump announced a sweeping tariff plan on what was called Liberation Day. Dow Jones Industrial Average moved up 1.4, 500 points, notching a ninth winning day in a row. Meanwhile, the tech-heavy NASDAQ composite climbed roughly 1.5%. Stocks moved higher on Friday after the monthly U.S. jobs report came in better than expected, but still not great, guys, indicating labor resiliency despite a stock market shock in April over tariff uncertainty. The U.S. economy added 177,000 non-farm payrolls in April, more than the 138,000 expected by economists. The unemployment rate held steady at 4.2%. Earlier on Friday, China said it is evaluating the U.S. officials' recent overtures on trade talks to assess how serious Trump's administration is about a shift in policy stance. Its Commerce Ministry said the door is open if the U.S. agrees to pull back on reciprocal tariffs, paving the way for starting formal negotiations. The comments helped ease worries that tariffs will stoke an economic slowdown brought into focus by Apple and Amazon and their earnings reports late Wednesday. Apple warned of a $900 million tariff headwind this quarter and cut its share buyback program by $10 billion, sending its stock lower in early trading despite its quarterly earnings beat. Meanwhile, Amazon shares were little changed after the commerce giant beat earnings estimates, but issued disappointing guidance that pointed to tariff and trade policies as factors. Okay, first off, Apple, $900 million setback. That is literally wow, I almost said fart in the wind, but I mean, I just said it, so I guess I should say it. That is a fart in the wind for Apple. $900 million, I mean, that's like an accounting error for them. So, and I say that as an Apple consumer. Also, think about all the other ways they make money. The Apple Store, they get 30% of everything purchased in the Apple Store. That's ridiculous. They have in-app purchases that they get a portion of. That's ridiculous. They have an immense amount of just non-iPhone, iPad, computer revenue that they could totally jump in and invest in instead of these physical products. So I'm not too worried about that. Okay, let's talk about the market really quick. There are a couple things, and I've only got 11 minutes here to, or geez, what is it? 9 minutes. I got 9 minutes to hit this home. First off, I want to clarify, this market is not real. What I mean by that is that the downfalls from when we were at like 6150 in February or March, it was synthetic that brought us here. Okay, it was synthetic. It was tariff talk. Tariffs do not work if they're implemented. Everybody suffers. But if you use tariffs as a negotiating tactic, okay, and you basically say, hey, I'm willing to suffer too. It's sort of like if you're in a volcano with your worst enemy and you just know you have to outlive them, you're right by the ladder, and you say, I'm not letting you get up this ladder. I know we'll both suffer, but you'll die first. That's what a tariff is. Okay. And ideally, the guy who's not closest to the ladder, the guy who doesn't have the advantage in the tariff talk says, okay, let's come back to the table. Let's figure this out. We'll work out whatever we got. Let's just both get up out of the volcano. And that is the dumbest visual you can think of, but that is exactly what these negotiations are. So once these tariffs get figured out, the market is going to boom. It is already about, I would say, 70% back to where it was from all-time highs, maybe 80%. And it's just rumors. There has been actually no deal done. So this is exciting and great news. And I said this weeks ago. I said, look, this is devastating for me. Okay, but I am buying stocks for clients, and I bought a little bit for myself. I was already very invested, but I said I'm going to buy because this, I believe, is synthetic. I believe it's temporary and it's not real, and this is a buying opportunity. Well, you know what? So far, so good. But it could drop down another 4 or 5% on some bad news that we don't know about, right? If there's tariff stalls, if inflation decides to kick up even more, it's past 2% right now. If that happens, there's going to be more buying opportunities, okay? So please, especially if you're young, take advantage. Now, I'm not saying go invest all of your money, okay? I'm not saying this is not specific. Put all of your cash into fuzzy XRP's meme coin. That is not this kind of advice. This is, hey, pay attention, be wise, and if you don't have a professional, use one. An RIA, fiduciary only. Do not work with somebody selling investment products, which is very easy. Hey, do you sell annuities? Oh, you do? Don't use them, okay? And that's a whole other conversation. But you guys can become wealthy even through these times. And it kills me. It absolutely kills me that people, like I had a client, and listen, one of my oldest clients. So when he speaks, I do tend to adhere a little bit of respect to the moment. And I just sit in it and I go, okay, there's value in what is being said. The exact words were, I don't know if I can invest in this. I don't know if anybody should be investing in this market until this stuff gets figured out. And that was referring to the political climate and everything going on. Well, okay, when is that? And now I look back and, wisdom and discernment is 2020 in hindsight. I'm a little bit angry that I didn't invest more money because of that conversation with him. It definitely put a, hey, look, there might be some wisdom in what he's saying, and really there is ultimately, but not in the way I invest client money or my money. Okay, pretty much everybody who's near retirement, they're not all invested in stocks, okay, and they shouldn't be. However, people in 2008 who liquidated their 401k, they weren't 65. A lot of them were in their 40s, okay, or early 50s. All they had to do was wait 2.5 years, 3 years, and their money would have been higher than it was the day before the housing collapse. But people couldn't wait. It's the same thing with what happened with this client earlier in the year. There's just immediate fear, and the stock market demands immediate gratification from people. It just does, and that's the name of the game. Are you stronger than your emotions, and do you have great companies? And I've said this a million times. The average person can be a millionaire and never own a single individual stock. All they need to do is be in the S&P 500. For me, in my firm, our risk tolerance, that is a 5 at the very best, 1 out of 10, the S&P 500, at the very best, okay? Because if you look globally, the S&P 500 is the U.S. economy, effectively. Okay, if that goes down, the whole world's in trouble and your money means nothing. But other financial advisors or financial planners will say things like, well, you need to be diversified in international equities and bonds and we don't want to be all in large cap stocks. We want to be in small cap stocks too. Those portfolios suck. Okay, yeah, it's not professional to talk this way about other people, but they're preventing they're preventing you from making the most amount of money you can because they're worried about your emotions. When in reality, your biggest, most important thing is, hey, is there going to be money? Is there going to be money whenever I retire? Okay, and nobody will give you a solid answer. They just won't. Okay, they're like, well, you're diversified and like we can't use past performance. That infuriates me because why would I use you at all? Why wouldn't I just be in the S&P 500 paying 0.04% to Vanguard and get my average 10%, right, index funds? Why wouldn't I just do that? Okay, that's what kills me. So I'm done ranting about that. But this stock market, there's still opportunities. And on Monday, my favorite stock, as you guys know, some of your guys' favorite stock, because if you're a client, you're invested in it, is Palantir. Okay? Palantir has a 2.5 beta, which means compared to the stock market, it moves 250% more in any direction. Essentially, that's the basis of the ratio. But guess what? Palantir's up 57% year to date. Stock market's down -2. Or -1. I haven't looked since the market closed. Now I know it ended up higher, but okay. Well, if it's beta, if its comparison is 250%, and either way, shouldn't the stock market be down 6 or 7%? But it's not. The reason for that is that these measurements, these ratios, the PEG ratio, the earnings per share, PE ratio, all of this information is just a little data point, and you're supposed to paint a picture with all of the data, and then you have to make a guess if that is a good company or not. You have to make that. There is no ratio, no equation that gives you the golden answer. All right, and that is why these ratio, like Palantir, I'm using Palantir again, and I'm going to talk about Palantir next week because they have earnings on Monday. But that's why companies like Palantir, their PE isn't actually relevant to a discussion about the valuation of the company, because the PE on Palantir is like 50 or 60 times. It might even be more than that. I haven't looked, but it's trading at such a multiple that people find that is a major no-no for some people. Okay, but they're not considering multiple things. Like, one, the stock price is updated every second. Okay, or we can say every day because the stock market does close, but it's virtually every second. And then earnings per share, which is a part of the PE ratio, so it's a very important factor, that's only updated 3 or 4 times a year at the quarterly earnings report. Okay, so you have to make an assessment of a company's PE that is so volatile like Palantir with 3-4 month old data from the earnings per share. It's not going to be accurate. Okay, so what's going to happen on Monday is they're going to say, hey, we have all these contracts. Look at all this new revenue we have. Look at how efficient we are at making money. And then we're going to get a new earnings per share. And once we get a new earnings per share, the PE is going to change. And then when the PE changes, there's going to be a whole new group of analysts that give you an assessment. And this is how it works with every stock. Well, guess what? They might be wrong too. People or the analysts are wrong all the time. Their estimates are almost never correct. They're roughly correct, right? You might say give or take 10 to 15%, but that's a large percentile. These people are not correct. So when you already see the information in the news, it's done. Okay, it's already done. You're dealing with old data. So what do you do, right? What do you do? Well, you either hire a professional who is looking for application, great companies, okay, with good revenue, and they have a great gross profit margin. Okay, those are the 3 things that we really look at. And there are other factors that affect it. Like if it wasn't Palantir, like if you told me Chili's, I think the ticker is EAT. If you told me the PE on that was 50 or 60, I'd be like, oh, I can't. That's a little different. But guess what? Chili's, the model is there. It's food. There is nothing really revolutionary that they can do to change that earnings per share. Okay, or that PE ratio. That their business model can't really change. But with Palantir, their software as a service. They don't necessarily have to pay. They don't necessarily have to raise costs to offer more services. Okay, their gross profit margin's like in the 80s. So that's very, very, very efficient. Meaning that for them to earn $1, it is not. It doesn't cost a whole bunch for them to do it. I have to look at the specifics, but they're very efficient at earning $1. Okay, look, I said I was going to be done. I think I've got 20 seconds here, so I will end it with that, guys. Great news for the stock market. Monday's Palantir's earnings. I hope you guys are ready to look at that with me. We'll definitely look at that next week. And guys, invest early, invest often. Happy you guys are here. I'll see you guys next week.